We're going to do the Chapter 17 handout. Not 17, Chapter 7 handout. I'm sorry. It's on bank reconciliation, and it's actually a more, which is part of a bigger picture thing called internal controls. So we'll start with that. And just to kind of give you a heads up, next Tuesday, we'll be doing the Chapter 8 handout, and those are the last two chapters we'll do. So Chapter 7 and Chapter 8 are the last two chapters. Thursday of next week will be the Chapter 7-8 practice exam, and I'll send out the exam on that day. And the exam is due on the last day of the semester on Friday, 12/17. Now, the last week of class, there isn't going to be a scheduled class. We're not going to cover new material in the last week. I will hold the class just in case people have questions. They want to go over something, or if they have a question with the class. But there won't be any scheduled new material on the last week. So the last week, your job is really just to get the Chapter 7 and 8 exam in. And that's the last exam. There's no final exam or, QSIP or anything like that. Okay, so that's kind of to the end of the semester, what we're going to be looking at. Any questions on that? Okay, I'm going to talk a little bit about internal controls. And internal controls are one of those things that is, it's basically, the company has goals and, things that they want to achieve or prohibit or whatever would be to benefit the company. And some of them are so prevalent that, it's something we don't even pay attention to it sometimes. For instance, if you ever go to a fast food place and you pay at one, you pay and then you go pick up the food. You say, well, why don't we just pay and pick up the food at the same time? Why not do cut out the where you said instead of having two people, have one person do it. Well, why don't you? Why don't they do it that way? They used to. Most places don't do that anymore. The reason they do it, is because, for instance, if you're working at McDonald's, at some point, if you're a cashier, by the end of the first day, you know how much a Happy Meal costs. You probably, rang it up 10 times. And, so a Happy Meal is $3.28. Well, it's possible that if they were both giving you the food and taking the money, they say it's $3.28. They take the money, don't ring it up, give you the Happy Meal, and so that would be the employee theft. If you keep them separated, they take the money, the order goes up on the screen, and someone picks the order. It's separated from the money. And if you don't ring it up, it's not going to be in there. People are going to pull up and say, well, where's my Happy Meal? So and sometimes they'll say, they'll have if we don't give you a receipt, tell us, and you'll get $5 free meal, whatever it is. That's another thing to make sure that they ring it up. So and again, a lot of times they're so prevalent that sometimes we don't even notice as to why. I don't know if you guys ever been into Home Depot. But in Home Depot, when you leave, there's someone there that checks your cart and checks your receipt, right, to make sure that everything's paid for. Why do they do that? Why do they do that? At Home Depot, when you leave, they check your receipt. They do it at Walmart too. They do it some other places too. But why?
They don't want you stealing.
Loss prevention.
Yeah, and quite honestly, a lot of those things are, it could be for shoplifting. A lot of times shoplifters don't actually put the stuff in the cart though, right? I mean, a lot of times they conceal it somewhere else. Those controls are mostly there for their employees. employees steal in a retail setting somewhere around 5 or 6 times more than shoplifting. Why? They have the opportunity. A big reason why they do that check at the door is to make sure that the cashiers are ringing up everything. So their friend comes through and they don't ring up for whatever, that it gets caught. And again, that's employee theft is way bigger than shoplifting. So while, yeah, they will look for shoplifting, obviously, but those kind of controls are really there for the employee, make sure the employees aren't doing something. So, and a lot of times things like the cashiers and that were kind of sophisticated that they would, they could steal a lot of money, a lot of merchandise or whatever really quickly. So anyway, those are controls we kind of don't even think about when you're going to the door. You don't think about, oh, they're checking to see if cashier number 17 rang up everything, or if we're best friends and cashier 17 didn't ring up half my stuff. So anyway, but those are internal controls, and those are, again, they're there. There's a lot of them. If you go into accounting and you go into, especially if you go on to be a CPA, controls are really big as far as make sure things are happening the way you want it to. Now, the thing we're going to cover today is bank reconciliation. And a bank reconciliation, it is a control. I think we'll go through it and then we'll kind of go back and see what things you can catch. But it's basically for your cash, and cash is obviously really important. And so bank reconciliation is one of those things that is very important to do. The bank reconciliation is basically to see how much cash you actually have. Because on your books, you oftentimes have one number. You get the bank statement back and it'll be a different number. Kind of like in your checkbook. In your checkbook, sometimes you'll so you have a balance of, whatever, $920, whatever it is. And you get the bank statement back and it'll be different. And bank reconciliation goes through as to why it is different and what is the correct amount, because the correct amount may be on the bank statement, it may not be. Okay, so the first thing we do on the bank reconciliation, we have the two sides. We have the bank balance, so this is off your bank statement. So this would be bank. And the book balance would be off your books, obviously, your accounting records. The accounting term would probably be general ledger or something along those lines. But so these are the two amounts, and you'll notice that, especially in this case, that these two are not the same. So you're looking at this, and say, well, I want to know what is really in the bank. Okay, so we start out, we put the bank balance on one side. Make this a little bit bigger. Okay, bank balance on one side and the book balance on the other. Okay, now we're going to add and subtract things from each side here. Or, well, you don't, not necessarily, but there are some things that could be added or subtracted to come up with the correct balance. Okay. What we do is that there are things that we know that the bank doesn't know. And there's things the bank knows that we don't know, and we're probably going to find it out on the bank statement. When we get the bank statement, we'll read the bank statement and go, oh, I see. Here's something that I don't have on my books. But there's also things that the bank doesn't know that we know. And deposit in transit is one of those things that if you make a deposit to the bank, it may not be immediately available. All right. So for instance, if you make a deposit on on the 31st. So you go to the bank and make a deposit of $1,485 on January 31st. It might not be on the January 31st bank statement. You know, especially if you make it later in the day, it probably won't be on there. Now, you made this deposit, but the bank doesn't know. So whose side are we going to correct? The bank or the book or our books? So we made the deposit. We know we made the deposit. The bank doesn't know.
Correct the bank.
Yep. Add or subtract, do you think?
Add.
Add. So we know we made this bank deposit. The bank just doesn't know. So we're going to add $1,485 to the bank balance. Again, they don't know that we made that deposit. We made it on the 31st. Maybe they don't count it till February 1st or 2nd or whatever it is. But we know we made the deposit. Okay. Outstanding checks. When you write a check, does the bank immediately know about it?
No.
It's really not. So, you know, you write a check, you put it in an envelope, mail it out. If you still do it, I don't know nowadays if you still do that, but if you write a check and put it in an envelope, send it out, you know, it's going to take some time in the mail to get to whoever it's supposed to go to. They're going to take it, put it in deposit, cash it, take it to their bank. It's going to take a while. So a lot of times outstanding checks are out there that you wrote, the bank doesn't know. So whose side are we going to correct? Book or the bank?
The bank.
Yep. And these are checks, so they will be less. So we wrote these checks. The bank doesn't know anything about them yet, but we do. So we're going to correct their side. Okay, bank fees. So, you know, if your bank account, your checking account, whatever it is, the bank fees. Do you actually write a check for those?
No.
No, the bank just takes it out of your account. So when are you going to find out about it? When you get in the mail or in the email?
Bank statement?
Yep. So you get this bank statement, and this is where you're going to find out about these. Oops, I can highlight correctly. You know, you're going to find out about these here. The bank statement, they'll say, we took out $35 for bank fees. And again, you didn't write a check for that. It's not going to be in your checkbook. Okay, so whose side are we going to correct? The bank side or the book side? So the bank has it on their bank statement. So which side are we going to correct?
The book balance.
Yep.
Accounting record.
Would we add it or subtract it?
We would subtract it from our account.
Yep. So bank fees, $35. And again, there's no check for that. They just take it out. Kind of rude if you think about it, but yeah, so the bank fees is automatically taken out. And again, it's not going to be in your books because you didn't write a check for it. And you only those things that you write checks for, whether they're electronic or paper, those are the only things are going to be in there. Note collection is kind of an odd one, so I'm going to just go ahead and tell you about that one. A note is very similar to a check. A note is if you sign a check, it's a legal document that whoever has that check can take that money out of your account. It's a legal document that you signed that is, authorizes that person to remove that money from your account. And if your signature's on there, it's authorized. A note payable is kind of the same thing. It's kind of like a post-dated check, and that they sign on it and they say, okay, it's a signature, it's a legal document that they can take, this money, whatever. And it's usually for some point in the future, 30 days, 90 days, whatever. Sometime in the future. And a lot of times it'll have interest too. And that's why, notes will say, okay, we'll pay 90 days and we'll pay interest rate of whatever, 5%, whatever it is. But it's very similar to a check in that it's a legal document, it's signed, it says that whoever has this, that they have the legal right to collect this money. All right, so let's say that this is a bicycle shop and someone comes in and buys a rather expensive bicycle for $1,700 and they say, okay, can I give you a note? And you say, okay, note's just like a check. Yeah, I'll take the note. Now, you're a bicycle shop, you're not in the business of collecting notes. It's very similar to a check. Well, banks collect checks all the time. So you may give that to the bank, and for a fee, they'll say, yeah, we'll collect that for you. So they'll collect the note. So you're probably going to find out that they collected the note on the bank reconciliation.
The bank statement?
Actually, I said it wrong. Yes. Thank you for saying the correct answer. Not the bank, on the bank statement, not the bank reconciliation. We're doing the bank reconciliation. Okay, so they collected this note for you. The bank collected this note, and it'll show up on the bank statement. You'll be the bank statement. Oh, I collected the note. Okay. So what do we have to do to our cash? We just found out about this, so we're going to be on the book side. Are we going to add this or subtract it?
Add the value of the note.
Yep. So now they collected the note, just like, if we deposited a check, they would collect the check for us, same thing. A very similar document. Okay, now on our bank account, we may have some interest income, and we may have interest income on this note too. Right, this note may have had interest, collection, whatever for it. When are we going to find out about this interest income? When we get the
That's the last of the month? Or
Yeah.
Okay.
Yeah, so this would be like on a bank statement. When you get the bank statement, they'll say, here's the interest that you got in your account. It could be from the account balance you have, but it could also be, in this case, from this note, may have had interest on it also. So you're gonna find out about all these things in the bank statement. Okay, interest income. We're gonna have to correct our side because we just found out about this on the bank statement. Is it gonna be added or subtracted?
Add.
Add. Oops, that's not high school income. That's some kind of a code I've come up with. All right, so interest income is plus 70. Okay, I think we have everything. I'm gonna move the accounts, just a moment.
Professor, I have a question.
Yeah.
Why is interest added to a note?
Because a lot of times it's for a period of time. So for instance, they'll say, okay, I'm not going to pay you for 90 days. Okay. And you say, well, all right. I mean, if I have to wait, I'm going to want interest to make up for that time that I don't have them. So a lot of times the notes will charge interest on it. And it varies by whatever, whatever's on the note. And Yeah, so the note collection will sometimes say, so for instance, maybe the note was for 1,700, but maybe we charged an extra, $20 of that was for interest. So it'd be included in this 20, here. So yeah, it's sort of like getting a loan, a little bit. It's like, you give us we gave them the bicycle. So they have the bicycle, but it's sort of like we loaned them the money, and now when they pay it back, they're going to pay it back with interest. So interest is common on notes. It's not always. It is possible to have a note that doesn't have interest. They have non-interest bearing notes, but a lot of notes, anyways, will have interest on it. That's a good question, though. Yeah, and that's unlike a check, because a check is immediate. So that because it's immediate, there is no time to have interest or whatever. But a note oftentimes is usually going somewhere into the future, 30 days, 90 days, 3 months, 6 months, whatever it is. That's a good question. Any other question on that?
I heard you mention the term general ledger.
Yeah.
Did we discuss that? I'm sorry, I wasn't in
No,
class.
it's a good question. It was actually in chapter 4. In chapter 4, we did the journal entries remember that thing with the T accounts? All those T's? That tedious thing, that's a general ledger. And actually coming down here, we're going to do journal entries. This is the sort of the T account on the general ledger. And notice we have 4,500, which is what we have up here. So this is what's sitting in the account. So we're going to have to make some adjustments here to this account because, well, here, let's finish this up, and then maybe it'll make more sense. Okay, so what we're going to do is add up both sides, and time for calculator cam. So, 1 second. Take my Band-Aid off. I gave my dog a treat the other day. She took my hand with it. All right, 6,000. $62.35. So this is the corrected balance, and we should get the same thing on the other side. So over here, we should get the same thing. Hopefully we do. Yeah, 62.50. Yeah, that's it. So this is the true amount of cash that we have. The true amount of cash is 62.35. So it's not 6,000, it's not 4,500, it's 62.35. This is the correct balance that we have for the cash. Now, there is a problem though. Now that we did this, our book balance is showing 4,500 in cash. I should have maybe done this a little bit differently. This down here. So, our cash account is showing that we have 4,500 in it, when we actually should have 62.35. So the question is, what do we have to do to get it up to this? Well, you'll notice that there's things that on our book site. Well, by the way, we can't go to the bank's books. They don't let you do that. Jerks. I might make a few adjustments on my account. Yeah, that looks better. But anyway, on our books though, we can go ahead and correct our books, correct it, but update them maybe is a better term for it. Doesn't like we did anything wrong. But we're going to update our books so that we have these things on them. And you'll notice something too. For instance, this note collection, we probably had this as a notes payable. Well, they paid us. So we have to take it off the books too. So we're going to go ahead and do this for, for these items here. We're going to make journal entries for them. And, these journal entries will have at least part of them, half the journal entry will be cash. Cash will be in each one of these because this is the cash account that we're looking at. And that's how we come kind of down to here. Okay, we got this 4,500. Cash goes up with debits, goes down with credits. So we got this 4,500. And we have to update this account because at the end we need this much in the account, the 62. Oh, give me a second here. Though. So this is what we need to have in our ending cash account. Okay, so let's go ahead and take the note collection. So our cash went up by 1,700. So down here to the cash account, are we going to debit cash or credit it?
Debit.
Debit. So cash is increasing. I can do this in capitals. I know it's kind of annoying, but just so you can see it better. It's an asset going up. You don't need to put that in. Okay, and so it went up by 1,700 for the note. Now we have this notes receivable on the books. And it's an asset. It's not how you spell asset. And it's going down. They no longer owe us for 1,700. They paid us. Okay, so this is the note. Our cash went up 1,700, so we put it in the debit. And you don't have to do this right now, but down here, we'd also put that as, now there would be a T account for notes receivable. We're not going to worry about that one right now. But so this would be 1,700 would be entered into the cash for this. $1,700. And we're going to do the same thing for the interest income. Plus 70, our cash went up by 70. I don't need to keep putting that in. I should stop it. So bad habit. So our cash went up by 70. The other side will probably have interest income. It could be interest revenue, something along those lines. Anything, interest, something that shows the interest coming in. I'll just use interest income. Oops. And this is sort of like a revenue account. It's money coming in. Oops. So that would be that one. Coming down here, we would put 70. So now our cash is going up by 1,700. It's going up by 70. We still have one more to do. And that's this one. Bank fees, cash going down. Will cash be a debit or credit?
Credit.
Good. All right, so we have cash. And what do you think is going to be on the other side? What's going to be the debit? I'll give you a hint. They're always debits.
Payable.
Close. My spacing get messed up. Things that are always debits. Probably some kind of an expense. Oh, it's called bank fees expense. It could be miscellaneous expense or something like that, but bank fees expense is a good one. Oops, can't find that. And if you recall, or maybe you're blocking it because it was traumatic, expenses are always debits. So these journal entries will now update our account. Okay, so we just put a credit for 35 in here. Okay, so let's get a total here. 6270. Say we have 35. Okay, and biggest side always wins, so we're gonna take 6270 minus the 35. And 62, oops. I'm sorry, hold on. So this will be our ending balance, and you'll notice that this is what we want the ending balance to be. You know, we want it to be this. Come on. So we want the corrected balance to be the same as what we have in our, so now we know. It's not letting me insert stuff. You know, now we have this corrected balance. And so now we're going to go into February saying, okay, we don't have 4,500 in the account. We really have 6,235. We don't have 4,500. We have 6,235 in the account. So that's how much we have in our cash. Make your planning, you know, accordingly. So the reason that we do this bank reconciliation is to really, first and foremost, to know how much cash we actually have. Question on that? Now, this is a little strange, so, you know, it seems a little odd. To be expected, I guess. Let's go ahead and do another one. My spacing got all goofed up here. Hold on. So let's go ahead and do number 2. Now, number 2, there's a new one. This. So this is when a customer hands us a check, we take it, we think it's okay. I mean, we may even have checked with the bank to see if it was okay. By the time that we put it in deposit and submit it, for whatever reason, it comes back NSF. All right. When are we going to find out about that? Well, that's a little bit of a, the bank might tell you immediately about it, but a lot of times they don't. When most likely are you going to find out about the NSF check? When you get the,
Is an NSF check, is that a bounced check?
yes, actually, you know, it just occurred to me, NSF sends they're not sufficient fund, or yeah, I should say not sufficient, non-sufficient or not sufficient. I'm not sure what they. So that's how the NSF comes from. And yeah, it's a check, sometimes called a bounce check. It's a check that doesn't have the funds available. So they write the check for 130. It's a legal document saying you have the right to take this 130 out of my account. And you go to deposit and there's not enough in the account to cover the check. So that's a non-sufficient fund. Now, we got this from a customer. So a customer paid us, we put it in the deposit and gave it to the bank. However, there wasn't the funds weren't in there. So we'll probably find out about that on the bank statement. It's possible they might notify you, they might just send you the check in the mail along with a fee. But if you're a bigger operation, they probably, and it's routine, they probably bring it to you right in the bank statement. Okay, where is that going to go on our bank rec? Whose books have to be, or I said it, the bank side or the book side, what has to be corrected?
The book side.
Yeah, book side. Okay, so as long as they're similar to that, so see if you can figure this out. I'll be quiet. Let's see if you can figure this one out. Nope. Oops. Where do you think that NSF check is going to go? The not sufficient funds check.
Added to the bank balance?
Close. You're not going to add it. You're going to.
Subtract it.
Subtract it.
Yeah, because here's the thing, that 130 is included in this 1355, even though we don't have that money. Not yet anyways. So the 1350, so we have to take it out of that 1355. We thought it was good, but it won't. So this will be, the NSF check will be down here. Okay, so corrected balance I got 1420. 1420. Hopefully that's what you guys got.
Yeah, that's what I got.
Okay. Let's scrunch it all up here a little bit. Okay, so we have to fix our books, or maybe not fix it, adjust them, whatever you want to call it, update them, maybe is a better term for it, for these four things. Because our true balance is that. We want to get to this number. So we have this sitting in our account down here. And we want to get it to this number, so we have to do these journal entries. Okay, so the pluses on the cash are on the debit side, plus. That'll probably be interest income. Could be also called interest revenue. It just depends on, tomato, tomato, doesn't really matter. But so this is basically, it's a revenue account though. It's money coming in. Note collection. Again, cash, debit going up. Oops. 200. And this would probably be a notes payable, some kind of a, not notes payable, a note receivable. And you might be wondering, you say, well, okay, why isn't that a revenue account? When you took the notes receivable, you already counted it as a revenue. It's kind of like notes receivable, kind of like think about accounts receivable. If you make a sale on account, remember we had accounts receivable and revenue way back in chapter 2 and 3. So anyway, so they've already counted the 200 as a revenue. Now we're just getting the cash for it. It's sort of like a delay, a delay thing. Okay, and bank fees. So cash is going down by 20. Some kind of an expense. Hey, they shorted a row here. Sorry about that. Now, the last one, NSF check. This one's a little bit strange. Now, you're tempted to almost put like an expense here or something about it. But are you going to forget about this check?
No.
No, no, you're mad about it. Yeah, so you're probably gonna, you call the person, say, hey, come, we got this bad check, come and bring cash and, pay for it. So you don't forget about this NSF check. They still owe you this money, right? They still owe you 130. And by the way, the incentive for them to do that is if an NSF check is, it's a legal document, and so if it's not collected, you turn it over to the state, and the state multiplies it by 3, and then goes after the person, and they can take your tax refund and all kinds of stuff to get it. But anyway, it's in everyone's best interest to come down and buy it. And by the way, sometimes it's not even the person's fault. The bank might have put a freeze on the account for some reason. They saw strange activity or something. Okay, so the NSF check. So these people still owe us 130.
Would it be accounts receivable or no?
That's exactly right. That's exactly right. Yep, very good. So you don't just forget about it. Yeah, they didn't pay you, but you still have this asset. They still owe you 130. And so you'll still try to collect that. So that one's kind of a strange one, and that, you know, you got to take it out of cash because you don't have the cash. You thought you had the cash, and the cash is included in this 1355. But you know, you got to take it back out because you don't really have it, but you're still going to try to collect it, and hopefully eventually it will get in there. Okay, so we have to, let's see, we have debit for 15. So for cash, we got to do this. We have to do this. So that's the debits, and we still have some credits here, though. We have to. Oops. So that's 20 and 30. Okay, so 1570 minus 150. 1420, and that's good because that's what we want it to be. Come on. Hey. Okay, close enough. All right, so yeah, so we want it to be the correct balance to be 1420 because we really don't have 1,355 in the account. We have 1,420 in the account. So one of the reasons why we do bank reconciliation is not just to, you know, make sure everything's on the up and up, but to figure out how much cash we really have. So starting in February, you say, okay, we don't have 1,355, we have 1,420. That's our real cash balance, and you know, we'll act accordingly. Okay, now a couple things about the bank reconciliation that are, you know, it was why we do it also. Suppose you have an employee that goes into your office and takes a check out, writes the check, forges your signature, takes it to the bank and cashes it. Doesn't have to be an employee, it could be anyone. Let's say somebody does that. It could be a customer wanders into your office. Actually, that actually happened. There was a case where that happened. And takes a check, your checkbook, writes it, you know, and forges your signature, goes to the bank and cashes it. You will find that in the bank reconciliation, because it's not going to be recorded on your books. So when you get the bank statement is going to be lower by whatever that check amount is. So if these two sides don't balance, immediately, you know that there could be a problem somewhere, and you have to figure out what it is. Could be an error, could be whatever. But if these two sides don't balance, then you got to start looking and see why they don't balance. And eventually, you're going to figure out that there's when they look at the checks that cleared, that hey, I didn't write this check. So one of the reasons why we do this, is to catch things like fraud and that. And I'll tell you a really odd one about the bank reconciliation. When I think I told you I wasn't a very good accounting student, but one of the things when you do the bank reconciliation kind of made sense to me just because I had a checkbook. So I used to do it. I used to do a bank rec on my thing, my bank statement. And one time it came up that was $500 off. And I went through and everything checked out. It cleared, but it was $500 off. And I would do this. I did this every month, and it was just kind of routine. I don't know why I even did it. I just, because it was something that I could relate again. So anyway, I couldn't figure it out. And then I realized the ending balance on from 1 month should be the beginning in the next. So if say you have whatever, $1,200 at the end of 1 month, the next month is just start out at $1,200. They had added an extra $500 into my account. I can't remember what the exact numbers were, but they had added. So the ending balance was, let's say 1,200. Go to the next month, it starts out at 1,700. So it did, like magically, an extra $500 from the end of the, So into the bank, I showed them. I thought for sure they were going to say, well, I don't want, I was afraid, So I went back to look, this is, they went through and they said, no, it's all right. I said, well, no, you added an extra $500. This is the ending balance of that. No. You probably made a deposit of $500. I was like 20 years old. There's no way I made a deposit of $500 and didn't remember it. So anyway, I always felt strange, but so I thought for sure at some point somebody were going to come back and say, "Oh, there's extra $500." So anyway, long story short, a couple of years later, I'm closing the account because I'm going off to college now. I went to a community college a couple of years, and I went to Illinois State. So anyway, I said, "Look, I'm closing this account now." Went through the whole spiel again. Okay, do you see this? This, extra $500 I added in, and they said, "No, everything's fine. Everything's fine." So I closed the account and I kept the $500. I don't know. So anyway, that was kind of an odd one. And, doing the bank reconciliation. Now, if I didn't do the bank reconciliation, I probably would have never figured that out. But it was kind of a strange, actually a very strange thing. I'm still not sure exactly why it happened. But I saw by somebody in the bank that they have to do a balance or something like that. And that might have been what they did to balance it or something. Just pick the random account, happened to be mine. I have no idea. But anyway, so any questions on the bank rec? Okay. Well, that's it for that. I'll actually go ahead and put this in the. You can submit it for to put it into the submittals. This will be due a week from today, the 10th. But I'll put this in for it. So chapter 7 handouts done. Next class we'll go over the chapter 8 one, and that'll be our last chapter. Any questions? Okay. All right. Well, have a good weekend, and I will see you guys on next Tuesday. All right. See you.
Thank you.
Thank you. Have a great weekend.
Hey, Professor.
Yeah.
Can you go over the last part of part 2 again? I just want to make sure I'm not missing anything.
This?
No, the cash part. Oh yeah, there we go. Okay, no. All right, thank you.
Wait. That was problem 1.
Oh, that was one. Yeah.
Here's problem 2.
Okay, there we go. Thank you.
You're welcome.
Not missing anything. Thanks.